Bing bong, we are back with another edition of the Sunday Scaries Stock Talk with me, a very hungover Brandon, and we got Dan, who I can't even come up with a nickname today, but brain's all mush. Hair of the dog Dan over here, getting another Corona in. Shout out the virus. All
It's
right,
Ro-
how you
it's
feeling, Dan?
it's Rona season, baby. I'm feeling good, man. Got some good sleep last night, which seems like you didn't. But I came prepared for this pod. I'm a team guy, always have been, always will be. I think our audience knows that about me. Um, so yeah, here I am.
Yeah, yesterday was Gasparilla here in beautiful Tampa, Florida. So I was I had a breaking news tweet at 9:12 a.m. that I was already lost in the sauce. But I didn't go out last night. I went to bed at 8 o'clock at night. So I did get some good sleep. I don't know if I'd call it sleep, but I had to keep waking up in the middle of the night to go to the bathroom. But here I am. I'm here grinding. I'm putting out content. I already ate some ketchup chips from the great country of Canada today, which were absolutely atrocious. Worst things I've ever had in my entire life. But yeah, I'm always here grinding out for the content. I got the sunglasses and Advil. And yeah, here we go. Let's get into the macro minute here, Dan. How are you feeling about the overall, macro environment? We know we had Powell made some comments last week. Why don't you give us a little bit of what he said and how you're feeling about it?
Yeah, I mean they had the FOMC meeting. Excuse me. And the Fed basically said that they were going to keep rates the same. They're pegged down between 0 and a quarter of a percent. That's not too surprising. I mean, they said they were probably going to keep rates this low until about March. They also said they're going to continue their bond buying, their asset purchasing. Basically, this is the taper they've been talking about. That's set to end in March, so that they won't meet in February. Their next meeting will be in March. Apparently, their taper will be complete in March, and that's when they are saying they're going to start raising interest rates. So I don't know, man. I might see them raise it by another quarter of a percent or something, jump from 0 to 0.25 to 0.25 to zero point 0.5. But if the market takes a hit, I don't see them continuing this strategy. It's a midterm year in the US, and a lot of voters look at the stock market. I think especially now, a lot of voters will look at the stock market because retail investing has gotten so popular, especially over the last 2 years. And so I also think that we kind of saw this last week and the week before, this major sell off. I saw some analysis that said like 60% of the sell orders were from retail, right? So I think people in retail are going to see the market come down a bit as rates go up and freak out a little bit, and then kind of conflate the market with the economy. And then they're going to look at the current administration and the people that are currently in office and say, well, the market's tanking right now. What else you got for us? So in a midterm election year, I don't see them raising rates too much. The big thing that I took out of the meeting or the presser after the meeting was Powell coming out and basically saying like they're going to be really flexible, right? So they're always hedging their bets. Like, oh, if something changes, we're going to be flexible with it. We're going to be flexible with it. Well, that flexibility might also be if the market starts to tank when we raise once, we'll bring it back down. So I don't know, man. As far as macro goes, I really think 2022 is none of this is investing advice, by the way. I really think that 2022 will be a lot like 2021.
Yeah, I tend to agree. And I also think it'll be pretty interesting to see because, one of our first newsletters that we wrote back in the day was, about the GameStop and AMC initial spike and how that was like, somewhat good because it got a lot of people investing in the markets. So it's always kind of dramatic, at least on Twitter, from what I'm seeing now, when you can tell like, who the newer people in the market, and it'll be interesting to see just how they react to a slight drawdown. If you look on Twitter, if there's like one red day of like, I don't know, a couple percent, it seems like the world's falling. So I tend to agree with your statement on that. And I think retail will probably overreact when there's a bit of a dip. But that also means a good buying opportunity, not financial advice, of course. So yeah, I know we've discussed it at nauseum. It seems like that we don't think that the Fed's going to raise rates simply because It's a midterm election year, and raising the rates could potentially affect the stock market in a negative way. So I assume that we'll see, more chatter, and they'll just keep kicking the can down the road about raising rates. And 2022 will be a very inflated year in the stock market. I thought Powell's comments were, somewhat interesting as well. They're always going to hedge their bets. They're never going to come out and say, back themselves into a hole or into a corner and say, we're going to raise rates, we're going to do it on this day, or we're going to do it on that, because, things change, and, policymakers always kind of have to hedge their bets in order to get reelected or make people happy, essentially. And so, I think it's just another instance of them kicking the can down the road. And I think that can will be kicked all the way till 2023 at the very least. So, not really surprised by me, but I know, a lot of people on Twitter kind of think that that they're going to raise the rates. I'm not in that camp, and I think that they even came out and said that, what was it? JP Morgan said that they would raise rates by like 7 or 8 times this year or something like that. So, for that to come true, they would need to start doing it, fairly soon. But like I said, I don't really see that happening.
Yeah, I agree 100% with all of that. The other thing, I mean, a lot of these people on Twitter that are saying this stuff I think they want to make believe like politics don't play a bigger role in it than they do. Like the Fed chair, Powell is appointed. He's not elected. There's no voting process for it. He's appointed by the current administration. And so his goal, if he wants to keep his job, and I'm assuming he wants to keep his job, I might be wrong about that, but his goal is to make the administration happy, right? If he wants to keep getting reappointed, so that he can write a book when the first year comes around that he isn't reappointed, then he's going to do what the administration wants. And right now, the administration is battling hard to get things like triple B passed, right? And then, of course, all of their statements are filled with things like the course of the economy in the future depends on the course of the virus. And so, hey, if they need to spin up a new variant and say this variant's terrible, we need to shut down again, they're going to. And I think they really tried to do this with Omicron. I don't think it really worked, but who's to say that another variant doesn't come out that they push hard and try to shut things down so that they can continue to print money? Because at the end of the day, they need to print money to make these things work. There's so many companies now that I forget what Masa was calling them the other day on the spaces, but we typically call them zombie companies that just sucked up all this capital. And eventually we'll figure out how to rip that audio out of those spaces and put them onto a pod. This, by the way, Brandon, I don't know if you saw this, but that the Choice podcast, Bitcoin is Hard, they did that. Their last podcast release was from a spaces. So there's got to be a way to do it. But anyways, yeah, there's a lot of these companies that are like zombie companies that rely on easy access, basically free access to capital from the banks. And so they rely on these federal interest rates being low and remaining low. Otherwise, what you're going to see is they're not going to have money. They're not cash flowing companies. They won't be able to pay their employees. So you'll see massive layoffs and you'll see unemployment skyrocket. And guess what one of the Fed's goals is long term? It's to keep inflation pegged at 2% year over year, and it's to have maximum employment, whatever maximum employment means. But if they start raising interest rates, how many companies over the last 2 years sucked up all this easy capital, started hiring like crazy, and then they're not cash flowing? They're not creating products that bring in any actual profit. So they're going to have to let all these people go. And then employment's going to go up. The Fed's going to see that, and they're going to say, damn, we got to bring rates back down. So it's nuts, man. It's absolutely crazy. But that's all I've got on macro. I know we want to jump into our stock breakdown. But yeah, final word on macro from you, Brandon. What do you got?
Yeah, I mean, I just agree with you 100% there. I think it's crazy that they're not going to, but they got to, they're in between a rock and a hard place. They have to either make wealthy people very happy by not raising rates, or help out the little guy. And the little guy doesn't always correlate, or doesn't necessarily correlate the stock market with with how the oh my god, my brain is mush. This is not great, but
yeah, that'll do it. That'll do it for our macro.
Yeah, there we go. That'll do it for the macro minute. I need a little McDonald's. Nice transition there. You can't coach that kind of stuff. But our stock breakdown of the week is McDonald's, the giant fast food chain. So I'll get into a little bit of it. For those who you don't know McDonald's, where have you been? McDonald's is like the largest fast food and restaurant chain in revenue, serving over 69 million customers daily. Nice. In over 100 countries, they have close to 40,000 different stores, and is also known, known very globally as it sponsors a lot of big events such as the Olympics, and I know that they've sponsored some other big sporting events as well. So as of this recording, McDonald's is trading at $256.09, and it's sitting close to the top of its 52-week range, which was at $271.15. It's got a market cap of 191.36 billion with a B. So overall, in the past quarter, it did very well, surprisingly. As more and more things started to open up and people started to travel around, and expenses grew, people seem to look to McDonald's as a cheaper, fast food, I guess, solution where they can wouldn't have to spend as much money and they could get their food quickly, as sales grew in Q1 to the highest that they've been since 2019, and it was primarily driven by the United States. The global sales increased by 7.5% across all segments, and their earnings per share was $1.92, which increased by 31%. So their PE ratio is 25.5, which is a lot smaller than a lot of these growth companies that we see. But yeah, overall, still kind of a high PE ratio, mid to high, I would say. And yeah, stock has been doing pretty well, surprisingly enough. And even with its raised prices and everything like that. So the McDonald's CEO came out and said that essentially that their overall operating costs rose by 14% in this past quarter, which is extremely dramatic, it seems. But they keep growing, and they, in order to do that and combat those increased prices, they raise their prices across their menu. So they raise the prices of Big Mac, Chicken McNuggets, which whatever, which gave it its highest revenue since 2016. McDonald's is also the most well-known global fast food chain, which I think that helps them kind of going forward, especially as more and more people, like I stated earlier, rent and taxes, gas, all that kind of stuff increases. People are going to be looking for more cheaper, faster options, as maybe they are having to pick up another job or something like that, or that they have a harder day at work or what have you. So they look for a cheaper alternative, and McDonald's is the brand name that people know. So whether that'll hold weight or anything like that'll time will tell. Yeah, so let's see. Let's get into the bullish thesis here, Dan. What do you got on the bull side?
Yeah, of course. So I don't know about you, Brandon, but I'm not a stockholder in McDonald's. Again, nothing that I say is should be construed as investment advice. I'm just a guy sitting here drinking a Corona, talking shit about McDonald's with an extremely hungover friend. So let's get into what I've got here for the Bulls. So you kind of mentioned it. McDonald's, it's a household brand. People know it. It's been around forever. I would bet that if you polled 10 people randomly off the street to name a fast food restaurant, the first response out of 8 of their mouths would be McDonald's. And yeah, that shows in their market share. They control just over 21% of the market share in 2021. That's global market share. And globally, the fast food industry is bringing in more and more revenue every year, right? So you and I kind of went back and forth about this before the show started. We saw a revenue growth, at least according to the data I'm looking at, in 2021 from 2020 to 2021 of about 9%, 9 to 10%. And then you kind of came back and said, yeah, but if inflation's at 7%, which is probably a low number for inflation, that's in the US. You have to think globally though. Then it's probably just staying even. So even if it's just staying even with inflation, I think, it's an industry that's not going away. I don't think the industry's in decline, and McDonald's dominates the industry as far as market share goes. So brand name, market dominance, all of that looks good. The other thing I've added here to my list of bull statements or bull arguments is that they're really taking a deep dive into automated order taking. And so I think one of your bear arguments will be increased cost to operate. And one of those increased costs is rising employee pay. So at least in the US, a lot of people now are pushing for this $15 per hour minimum wage. Well, one of these things that companies are going to start doing when they start losing profits because they have to pay employees more is they're going to start automating things. And McDonald's is at the forefront of this, in my opinion. They in 2019 bought or acquired a tech company called Apprente, and then they turned that into McD Tech Lab, I believe is what it's called. Yeah, McD Tech Labs. And McD Tech Labs is actually going to be sold now to IBM. And McDonald's has said that this is going to be a strategic partnership with IBM to scale up their automated order taking projects. And so this is in restaurant and through drive-throughs, right? So look, you wanted $15 per hour. Look what McDonald's is going to do. I would not be surprised if other companies start doing the same thing. When you look at Walmart, for example, every grocery store I go into now, their self checkouts are much longer lines, or not longer lines, much larger. Like in scale, there's more self checkouts than there are in-person checkouts. So I wouldn't be surprised to see more of this happening. And McDonald's seems to be taking it really seriously. Like a partnership with IBM is huge, in my opinion. And then the last one I have is McDelivery. So they now at certain locations offer delivery. This has jumped significantly. I believe in 2019, they had just 3,000 locations offering this, and now they have more than 30,000 locations offering McDelivery. Now, these aren't McDonald's employees delivering the food. They're still relying on DoorDash and Uber Eats, but McDonald's is basically saying we're one of the largest we're the largest fast food restaurant chain in the world. And so we can drive more and more customers onto your platforms. So they think that they should be given special rates, or they think that they can negotiate special rates for using services like Uber Eats and DoorDash. Now that's not set in stone, but it's something that they're probably going to try to argue. And who knows, maybe they'll get better rates than other restaurants. I know generally speaking, restaurants don't like relying on these third-party delivery services because they eat into the margins. But if McDonald's can get good enough rates, look for McDelivery to get bigger, and yeah, who knows if they can make the margins work? That could be a cash cow for them. That's what I got for bulls.
All right, so then I'll get into, a little bit of the bear arguments too, and then we'll give our opinion overall on the stock. So the three arguments that I made, you mentioned one of them is an increased cost to operate. I kind of mentioned this earlier. The overall prices have, business operating expenses have risen by 14% in one quarter. So, in order to combat that, they did have to raise prices, which didn't seem to affect revenue. In fact, it seemed to benefit the revenue. But, overall, the more and more that they increase prices and things like that, the worse it's going to be, I think, in the long term. I think if prices get more expensive, less and less people will shop there because people look for fast food as something to get there, to get quick food, maybe not necessarily the best food, but quick and very cheap. So like you're saying, there's going to be more and more increased costs to operate. I think we'll be seeing more and more of the automated checkout registers instead of people just at the register. We'll see more of these touchscreen things that I've been seeing in some of these fast food restaurants. I don't necessarily eat at these all the time, but and the ones that I have gone to, you usually see like 2 or 3 options of where you can go and skip the line or do something and just kind of automate it, or you could order through the app. So there's various ways that you can order without having to interact with somebody. And I think those trends are going to increase. And so that could, help with getting rid of the, $15 minimum wage operating expense increase. But, another negative that has come from that is that there's massive staff shortages. I know we've kind of detailed in our spaces and in other places that when we go to restaurants, we go to grocery stores, we go to all these places, there's now hiring signs all over the place. And I think that trend's going to continue. More and more people are looking to get paid more, remote work, and seemingly like not work as hard. It seems like, as unfortunate as that is. I have some friends in a text message group here that went to breakfast this morning, and they said that there was multiple empty tables, but they weren't being sat because of staff shortages. So not only is that not affecting places like McDonald's, it's affecting the restaurant industry as a whole. And I think that, that's going to continue to affect McDonald's in a negative way. That they're going to probably have to pay a little bit higher than they would like. And, that will probably cause increased prices in, their food, which is kind of their bread and butter, just having these cheap and reliable food options where what you're going to get and what it's going to taste like and everything like that. The last point I'm going to make for the bear thesis is the post-pandemic health trend. I think that there's more and more people kind of focusing on their health, whether it's by trying to get the vaccine or what have you. More and more people are being aware of their daily habits and things like that, whether it's sleep, caffeine, diet, exercise, whatever, how that kind of affects their overall health. So I think less and less people are going to be eating fast food daily, and the increased prices and everything like that. It has affected McDonald's drastically, I would say, in the past year or so, except for this past quarter. So this past quarter is kind of encouraging for McDonald's investors. As Dan kind of said earlier, he's not a McDonald's investor, and neither am I. But I think these past quarter results were somewhat encouraging if you're worried about the health trend. But I think it could just be, another one-off quarter where maybe they had more people come in than normal, or it was also around the holidays and things like that. So people were cooking big meals, and they're in between meals or something like that. They would go to McDonald's or anything like that. So I would be, wary as a McDonald's investor looking at their food trend, as McDonald's kind of has that negative connotation of not quite the healthiest food. So overall, I guess I'll give my opinion here on McDonald's, and then Dan, I'll let you go. Overall, I'm not going to invest in McDonald's. I'm not a really big supporter of this industry, to be honest. I don't think it's great for people to be eating fast food and things like that. I know that there's like some experiments where people have left like a McDouble out for years and nothing seemed to change or anything like that. So, the food has its staying power for whatever, you want to say about that. I think that it's pumped with some bad chemicals and things like that for you. And, overall, I think that going forward, more and more people will either, cook or look for another alternative. So there's some people still worried about leaving the house and going to dine at these kind of places. And I think the McDelivery is good and exciting for McDonald's, but that also means it's increased price. So if you're going to get some food delivered, why would you get McDonald's delivered when you can get something else delivered for maybe just slightly more expensive, and maybe a little bit better quality too. So overall, I think that as an investor, I wouldn't be investing in McDonald's. I'm still wary on a lot of these, shortcomings that McDonald's has had, but they also do have a very, very, very big real estate footprint and have real estate in some of the biggest and most desired sections in the world, like such as Times Square and places like that. So overall, I think McDonald's is a good company, and I wouldn't hate anybody for, I wouldn't say never buy McDonald's stock or anything like that. Of course, it's not financial advice, but, I just don't really think it's an investment that really suits my investing thesis. I think it's a good company. It seems to be doing well. But yeah, like I said, overall, I don't think it's one necessarily that I'm going to be investing in. Dan, what are your thoughts?
Yeah, I go back and forth. I have no short-term plans anyways to buy McDonald's stock, but it'll be interesting to see how they leverage technology with the automated order taking to drive down costs of operation and drive up revenue. We'll see. I don't know. I had a professor when I was an undergrad that said the only thing worse than going to bed hungry, or wait, No, it's going to bed hungry is bad. Man, I forget exactly how he put it, but it was basically like people go to fast food, get fast food because it's something to eat and it's cheap, right? So the it's I can't think of the what exactly he said, but it's like, yeah, you could go to bed hungry or you could go to bed with cheap bad food in your system. And that's why people go to fast food restaurants, because it's cheap and it's fast, right? McDonald's and other fast food restaurants, at least around me, they're not getting cheaper and they're getting slower. There's fewer employees and the prices are going up. So it's like, am I really going to go to McDonald's and pay $9 for 10 chicken nuggets when I could go to a slightly higher quality food and pay $13, right? It's like, what am I willing to pay that extra $4 to get much, much better food? In my case, I am, because that $4 at the end of the day isn't that big of a deal to me, but there are a lot of people where that $4 is just a deciding factor. So we'll see. I mean, I think if they adopt these newer technologies, technology in itself is deflationary. If you scale it appropriately, you start to rely on software, which is much cheaper than relying on human labor. And so it can be deflationary if they use it and scale it in the right ways. And so if they can do that, and look, if there's a company that knows how to do that, it's IBM, right? So the strategic partnership with IBM is something to really look at closely. And yeah, if they can drive down those costs, what did you say? It was like a 14% increase
Yeah,
in one quarter.
14% increase in operating expenses.
Yeah. So if they can automate some of these processes and really drive that down, I think that could be huge. I look at Chick-fil-A. If you're a fast food company looking to understand how to quickly get people food and like good quality food, in my opinion, look at whatever Chick-fil-A is doing, because Chick-fil-A has this down, man. They get people in and out fast too. And one of the big ways they do that is through their app. Like, it's so easy to purchase and then show up. You go to a spot, you tell them what spot you're in, they bring it out, boom, done. Their drive-through goes really quickly. Like, they've figured this stuff out, man. They've really strategized it and figured out how to get people in and out quickly. The food's not that expensive and the food's good. So if you're looking to figure this stuff out, man, try to figure out whatever Chick-fil-A is doing.
Well, I think what too another point is that, to own a McDonald's franchise, it's very expensive. I don't know the exact figures, but I believe it's like somewhere in the ballpark of like $1 million. But to own like a Chick-fil-A franchise, it's a lot cheaper. I think it's like 100 to 200,000 depending on where you're at. And in order to own a Chick-fil-A franchise, you have to like basically work in it. And so that person who's invested a lot of money in that has a little bit more of a, I guess, incentive to make sure that people are getting in and out quicker, just because they're financially like not only working in it, they're financially responsible for it. Whereas usually if an investor owns a McDonald's franchise, I imagine they're not going to be the general manager or the manager of that place. They're going to own that place and then just be like, all right, I'm hiring this all out, and that's kind of don't my hands are kind of free and clear of that. So I think it's interesting to compare it to Chick-fil-A. But yeah, I mean, I think McDonald's has a brand name. People think that probably think that Chick-fil-A's food is a little bit better, but there's plenty more locations of McDonald's than Chick-fil-A too. So McDonald's has that giant footprint, whereas a lot of these other fast food chains might not. If you do some road trips and you're driving, you're always going to see a McDonald's probably at almost every exit. There's going to be something like that along the lines, and there's not necessarily that for other places. So in some places you might only have that as an option, which is good. But yeah, like I said, I'm not really looking to invest in McDonald's. I think the stock's been doing pretty well. But yeah, I don't know. Any closing remarks on McDonald's?
Yeah, my big thing is I want to know how well they utilize this technology, and then if that can drive prices down. Again, you go to fast food because it's fast and it's cheap, and it seems like the few times in the last few months that I've gone to fast food, it seems like it's taken forever, and I get my receipt, and it's like it's so ingrained, at least in the US, that when you go to a fast food restaurant, you're going to pay like $6, right? Like $6 or $7. But now I'm getting these receipts as like 11, 12, $13. You're like, whoa, wait, what? Yeah, I'm eating this bad food now for $13. And you start to think, why am I eating? Well, it took them 10 minutes to eat me my food and I paid $13. It's like, why am I eating here instead of just going somewhere that's better? And yeah, they can't figure that out. I just don't understand what fast food's providing other than like maybe nostalgia, but you don't, it's nostalgia isn't a great market. So we'll see.
I also think too, people are kind of creatures of habit too, so
Yeah.
I know there's like a real estate group down here in the Tampa Bay area, and they go to McDonald's. I forget which day of the week it is, but they go to McDonald's for breakfast, the same one every single week at the same time, and just discuss real estate, and that's what they've been doing for years. So even though the prices are increases, some people are just love their whatever, the McDonald's coffee or what McGriddle or whatever it is. So I think like I said, people are kind of creatures of habit, and fast food isn't going anywhere like you said. So I don't know. We'll see. It'll be interesting to see kind of where this food trend goes. And I think fast food, because they have such little margins, and how a company like McDonald's basically works is that they can price everything so low because they sell so much product compared to the mom and pop burger shops where, you need to sell maybe, I don't know, 10, 20 burgers or something within an hour in order to combat operating costs. Whereas McDonald's, they just have it down to a science, so they can sell 40 or 50. And, they have so many people coming in and knowing what they're going to get, that they can just price everything so much lower. So I think there's like a growing movement kind of away from these chain restaurants. At least that's what I'm observing. And yeah, like you said, it's getting slower and slower to get these foods, so I don't really see fast food overall being something that's strong and standing. But I also think that it's such a big industry that it's not going anywhere, and so many people have created habits around fast food, whether it's McDonald's or any other of their competitors. So I guess that's it for me. If you don't got anything, I'll wrap it up.
Yeah, I think that's good for now.
Yeah. All right. So I'm Brandon, and that's Dan, my co-host here. We're coming to you from our Sunday Scaries Stock Talk edition. It's our second one. If you enjoy this video or like this content, be sure to let us know in the comments below. Like and subscribe to our channel, as we're going to start cranking out more and more videos. We'll probably start putting up some of our spaces as well, little shorts here or there, so you can kind of join that. Follow us on Twitter and Instagram at Green Candle IT. The Twitter spaces that I mentioned, we host at every Tuesday night at 8 p.m. Eastern time, and that's more of a macro stock kind of talk, similar to this video. And then Fridays we host a Twitter Spaces with a big group at 4:30 p.m. Eastern time, and that's our Bitcoin happy hour. So we get people from all over the globe, and that we get a lot of cool guests and things like that. But yeah, also subscribe and check out our newsletter. We're putting this in our newsletter. That's on Substack, greencandleinvestments.substack.com. Anything else that I'm missing, Dan?
I think you nailed all of it. Yeah, we're trying to expand out too. So just follow. Best place to do it is just follow us on Twitter. That's where we're posting the most up-to-date stuff. And if we change anything, like what platforms we're using, as we start to roll out more and more, you'll see it on our Twitter for sure. So that's the best place to follow us.
Exactly. All right. Well, that's it from me and Dan here at Green Candle. I hope to see you guys interacting with us, and let us know what you think as we kind of hungoverly put out this kind of content. So, all right. Bing bong.